Have you spent hours online trying to understand debt funds only to end up more confused with every search? Well, we've got you covered. Introducing All About Debt Funds, a 10-part series by Bajaj Finserv Mutual Fund designed to simplify the world of debt funds. Over the coming weeks, we'll break down complex concepts into simple terms, helping you confidently invest in debt funds. Whether you're a beginner investor or a seasoned one, buckle up and get ready for the ride ahead. What exactly is a debt fund? Let's break this down with a simple example. Imagine you have some extra money and you decide to lend it to a friend who needs it to fix their bike. In return, your friend promises to pay you back with a little extra as a thank you. Let's call that interest. Now, imagine this. Instead of your friend, think about large corporations or even the government needing capital to fund their projects or operations. They borrow that money from investors just like you. This is where debt funds come into play. Picture yourself pooling your money with other investors, creating a collective pot of capital that's then lent to these organizations. In return, you receive steady interest payments, just like you did when you lent your money to your friend. But now, you're a part of something much bigger. It's a way to earn a return by helping fund everything from infrastructure projects to business expansions, all while managing your investment risk through diversification. Now, you must be thinking, if debt funds let you invest in a company, then aren't they same as stocks? It's a common question, and while both allow you to put your money into companies, the answer is actually no. Let me walk you through why they're different. Stock and debt funds differ in two ways: volatility and returns. Let's start with stocks. They can be thrilling, offering the potential for rapid growth, but they're also risky, kind of like riding a roller coaster. When you buy stocks, you're buying a piece of the company. Your returns are tied to how well that company performs. If the company succeeds, your investments can soar. But if it falters or doesn't meet the expectations, you could see your money drop just as quickly. Debt funds, on the other hand, offer a much steadier journey. Instead of the ups and downs of stocks, debt funds focus on fixed income investments like bonds, treasury bills, and other debt securities. These investments provide regular stable returns, allowing you to earn interest without the roller coaster ride of stock market fluctuations. Unlike stocks, debt funds aren't about owning a piece of a company, but rather lending your money to organizations, whether they're corporations or governments. In return, you'll receive regular payouts, typically in the form of interest. So if you prefer a calmer, a more predictable way to grow your money, debt funds are an excellent option. Now, why are debt funds such a smart choice? Because they're part of something called as fixed income investments. This means you get regular payouts, usually in the form of interest. For example, lending money to the government through bonds can be considered very safe. They're reliable borrowers. Companies also borrow through bonds, and depending on their financial strength, their bonds might offer higher or lower returns. A financially strong company may offer bonds with lower interest rates, reflecting its lower risk, while a company with a weaker financial position might offer higher returns to attract investors, compensating them for the increased risk. Think of it like this. Lending to the government is like trusting a super responsible friend who always pays on time. Lending to a company is like helping a friend start a business. It's riskier, but if their venture succeeds, they might reward you with higher returns. Here's a cool fact. Debt funds don't just put your money into one thing. They spread it across a variety of options to reduce risk. These include government bonds, corporate bonds, treasury bills, commercial papers, certificate of deposit, and sometimes even securitized debt instruments. This strategy of diversification ensures that your investment isn't reliant on the performance of a single borrower or asset. By spreading your money across different types of debt, debt funds help make your investment safer and more balanced, offering you a cushion against potential losses if one asset underperforms. It's a smart way to manage risk while still earning steady returns. Now for your first task, think about this. Are you someone who's okay with taking risk for potentially big rewards? Or do you prefer steady, predictable returns? Write down which type of investor you think you are. This will be the first step in your debt fund diary. Drop your answers in the comments below. I'd love to hear your thoughts. I would want to know which side you lean on. We've covered the basics of debt funds. In the next episode, we'll talk about how debt funds fit into your overall investment plan. So grab your pen and paper and I'll see you in episode 2.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.